Well, joining me now to talk more about the markets and interpret this data is Seamus, Smyth, Chief Economist at Virtus Partners. Seamus, it's great to have you on the show this morning, and investors certainly welcoming this inflation read this morning. What is your takeaway?
And I think what we're seeing is the inflation progress broadly continuing. I think the numbers, if you dig underneath the surface a bit and sort of the parts of the report that matter for the inflation that the Fed actually cares about, the CPI and the PCE, it's a little bit less friendly. Some of the details there, I think, are not quite as good as what we're seeing. But sort of a little bit better news than we've gotten out of some of the more recent ones. But again, I think what really is going to matter is what we actually get from the CPI tomorrow for thinking about the Fed and how they want to see things go.
You know, many people have said, Seamus, that PPI, the Producer Price Index, what businesses pay, or these wholesale prices, the pace of price gains that this particular index does measure today, is more of a forward-looking indicator, a leading indicator perhaps by about 6 months as to what we might see with CPI. Do you agree with that, and what could that portend for consumer prices?
I think you have to be very careful with that. The links can be a little bit tenuous, and the sort of what you see out of there doesn't necessarily always translate. Again, I do think what you're seeing on the inflation front has broadly been good news, and this is a little bit of continuation of that. But I don't want to get too excited about the PPI just because the links just aren't as tight as you would hope that they would be.
Does this signal that the economy is strong?
I think the economy is strong, and I think that's very clear on the activity side. I think one of the reasons why you're seeing a little bit less progress on the inflation side over the last 3 to 6 months than you'd hope for is that the economy has remained strong. You're potentially seeing a bit of a pick back up in the pace of job gains as we've gone into the end of the year, and overall consumption and overall economic activity looks extremely solid as we go forward. GDP continuing to track north of 2%, which sort of given where we are is an extremely positive one. So yes, very much so. I think this is related to the overall strength of the economy.
You mentioned we got the Consumer Price Index data for December. That's out tomorrow morning before the market opens. Of course, our viewers will be following that closely, and we'll be covering it here on our show. And that's just 2 weeks ahead of the Fed decision at the end of January. Seamus, what do you think is the right move from the Fed come 2 weeks' time with these new data inputs?
I think that you have a Fed that is looking at sort of the overall picture, seeing the little bit of backsliding that we've gotten in inflation over the back half of 2024, and is looking to be a little bit more cautious, and has thinking that they are in a much better position with the amount of rate reductions they've already done, and wanting to gather a bit more data as they go forward. So I think and I think this is pretty clearly indicated by Powell at the last press conference. What you're looking at is sort of taking a little bit of time to assess where we're going and not having to cut at this next meeting. Instead, sort of trying to understand a little bit more about that path of inflation. And I think they're very interested in some of the early 2025 readings that we're going to get on inflation. They're going to be very informative about where the path is, because if you recall last year, we had a little bit of an upside surprise at the beginning of the year in inflation readings. And I think the Fed probably has some concerns that some of the same factors that pushed up there could occur again, and we'll want to see what they get before sort of making the further moves.
Of course, the Fed has a dual mandate, right? So it sets interest rates based on inflation as one input, the other input being jobs. And the jobs report Friday was a blowout. 256,000 jobs added in the month of December, 101,000 more than expected, for a total of 2.2 million job additions in 2024. Do you expect this momentum to continue at the same pace?
I don't think you can expect it to continue at the same pace as we go forward. I think there are a variety of reasons that are there. One of them being the sort of lag tightening that we have seen from the Fed continuing to feed through. And if you look at what you saw through the course of 2024, you saw a gradual slowdown in the pace of job gains, albeit to a still very good level. But then also when you look forward, I think you have to consider the amount of immigration that has been coming into the country, that having been a major factor in helping keep job gains as strong as they have been over the past 18 months or so, that having already come down towards the tail end of the Biden administration and likely to come down further as we go into the Trump administration, and going to get a slower pace of job gains with that lower pace of immigration.
Seamus Smyth, Chief Economist at Virtus Partners. Seamus, thank you so much for joining, of course, amid a big data release.
My pleasure.